Welcome to Mr. Data 369 YouTube channel, where we present stock market concepts in easy to understand style. What are call options in the stock market? Before getting into details, let's learn about Raj's story. Raj had always wanted to be close to his family and to create a dream house in his hometown. But with real estate prices skyrocketing week by week, it seemed like his dream would never come true. Raj heard in his hometown, some real estate companies are building homes at a cost around 50 lakh rupees. Initially he was excited, but later he got sad when he learned that he will not get a bank loan for that amount until he gets a salary hike, which is due next year. One fine morning, Raj met with a real estate agent and explained to him about his situation. Agent said Raj had to pay an advance of 25,000 rupees to reserve his spot now, and then he would have the option to buy the house later within 1 year as per the agreement. Agent also said he is not obligated to buy a home if doesn't have money by that time, but he will have to lose his advance paid. If house prices increase like 55 lakhs in the next 1 year, Raj can simply sell his agreement contract to a new buyer and keep the profit of 4.75 lakhs without even buying the house. Raj was happy and curious at the same time about the option he has now. It felt like he was playing a game with a grand prize. He decided to take a chance and pay the advance to secure the option. From that day on, Raj was on a mission. He saved every penny he could, working hard and dreaming big. As he got closer and closer to his goal, he faced obstacles and challenges, but he never gave up. And finally, the day has arrived. Raj had saved up enough money to exercise his option and buy the house. It felt like he had won the biggest game of his life. It was a happy ending that he had always dreamed of, buying a house in his native place. Nice ending, but what does Raj's story have to do with call options in the stock market? Okay, now let's see, what is a call option in the stock market? A call option is a financial contract that gives the holder the right, but not the obligation, to buy a certain stock or other underlying asset at a specific price, known as the strike price, within a certain time period. In simple terms, it is a type of agreement where you have the option to buy a stock at a certain price, even if the market price of the stock goes up in the future. This can be useful for investors who believe that the stock price will rise and want to lock in a lower price. However, if the stock price does not rise as expected, the option may expire worthless and the investor will lose the premium paid for the option. In the Raj story, he bought a call option for his future home. What he paid is called advance payment in real estate scenario. In this stock market scenario, advance payment is called premium. Raj's expected target price 55 lakhs is called strike price, assumed price number. During this 1 year period Raj had, if housing market collapsed and prices come down to 40 lakhs, Raj can simply walk away from the agreement, but he lose initial advance or premium amount he paid, which is 25,000 rupees. Now let's see with the stock market example of Reliance stock. You have faith that the Reliance stock price will go up in the next 12 months, and you want a piece of the action. Now, you have two options: you can buy the stock outright, or you can buy a long-term call option. A call option is like a coupon that gives you the right to buy the stock at a predetermined price, even if the market price goes up. It's like buying a pair of shoes on sale, and then using a coupon to get an even bigger discount later on. So, let's say you decide to buy a call option with a strike price of 3,000 rupees. This means that no matter how high the market price goes, you can still buy the stock at 3,000 rupees per share. Of course, there's a catch: you have to pay a premium of 100 rupees per share for the option contract. It's like buying that coupon for a discount, but you have to pay a little extra to get it. Now, if the stock price goes up to, say, 3,500 rupees per share, you can still buy it at the discounted price of 3,000 rupees. You can then sell it for a profit of 500 rupees per share, minus the premium paid for the option. It's like buying a pair of shoes on sale, and then selling them for a profit later on. But if the stock price doesn't go up, and stays below the strike price of 3,000 rupees, the option will expire worthless. It's like having a coupon for a store that goes out of business before you can use it. You're out of luck, and you lose the premium paid for the option. So, the moral of the story is, if you are going to buy a long-term call option, make sure you are confident that the stock price will go up, and that the potential reward is worth the risk of losing the premium paid. Now let's see pros and cons of buying call options. Advantages of buying or going long on call options. Leverage. Call options allow you to control a large amount of stock for a small amount of money. Means, sometimes you control more stock than you can afford with your current budget for popcorn price at multiplex cinema halls. 2. Limited risk. The most you can lose is the amount you paid for the option, which is probably less than what you spent on your last cricket match ticket. 3. Potential for unlimited profits. There's no limit to how much the stock price can go up, and your profits can increase accordingly. Flexibility. Call options can be used for different purposes, such as generating income, hedging against losses, or speculating on price movements. Reduced capital requirements. You don't need a lot of money to buy call options and can control more stock than you could afford to buy outright. Disadvantages of buying or going long on call options in stock market. 1. Time sensitive or time decay. Call options are like a subsea vegetable. They lose value over time. So, make sure to use them before they expire, like your vegetables in the fridge. 2. High volatility. Call options can be like playing a game of Teen Patty, Indian card game. Means, you never know when the stock price will drop and you'll be left holding a losing hand. 3. Limited time horizon. Call options are like seasonal fruits. They only last for a fixed period of time, because options have expiry date unlike stocks. So, make the most of it before it's too late. Potential for loss. Call options can be like matka, illegal betting. You might win big, but you also might end up with a fatak, bust. 5. Complexity. Call options are like riddles. They can be confusing and require a lot of patience and skill to understand their price movement behavior, like any type of option contracts in derivative markets. So, make sure to do your homework before investing. Buying options is easy. Making money out of it is the real challenge. Investing in call options, like any investment, can be risky and requires careful consideration of the potential rewards and risks involved. In short, the moral of the story is that investing in call options requires caution and research, but can potentially lead to occasional big rewards. This video is made strictly for education purpose. Consult your financial advisor for your investment-related decisions. Thank you and have a blessed future.